Alrighty guys, welcome to a new video. And in today's video, I thought it'd be funny and interesting to go back to some of my oldest videos on ICT Macros. So you can see here, this is posted a year ago. And this is still when I was trading probably the New York session and a mix of both New York and London. So I'm gonna play parts of this video, I'll play it out and then I'll give you my thoughts as we walk through because my trading style has changed slightly, but I've always been using macros. So let's get straight into it. And I'll tell you guys what I think as we let it play out.
Alright, so in this video, it's going to be a part 2. I've got another video on this. I'll put these in a playlist so you can look at. There's 2 macros for AM session. If this is the first video that you're seeing, the first macro is from 9:50 to 10:10 in the morning. And the second is from 10:50 in the morning to 11:10.
So that is still the same. Like if I was trading the New York session, I'm still going to say that those 2 macros exist. I think nothing is different in that area. What I'm saying here is true as well, right? I talk about in a macro, do we raid liquidity? Is there a market structure shift? Or what else could it be telling me? And we'll just keep playing it. And I'll talk about some differences that I use now in my trading as opposed to 1 year ago.
The kind of frame trades a lot of the time. Like if I can get a setup to form in that macro period, it's going to be great, especially if there's multiple confluences and I've got a clear draw on liquidity. So let's start from Friday, right? Now the first macro, working our way back, 10:50 to 11:10. That's 10:50 there. 11:10 is here. Between these 2 green lines, have a look.
Now, before I even go into my analysis here, I think the interesting point here is that I talk about market structure shifts. These days, I don't really use market structure shifts. Like I see them visually, but I won't mark them out. I'm more looking at inversion gap. So what I'll mark out on the screen here is an inversion fair value gap. And this is a really strong one. This one right here. And you can see that we react from that during the macro, but for me now, I'm still using the macro. I would still take these trades like to the upside, a long position. So we'll see what happens as we go through, but I'm talking about a rate of liquidity there, a market structure shift. And I think to be honest at this point, I was still trading the 2022 model. So sweep of liquidity and sell side, market structure shift and return to a fair value gap. These days, like I said, I'll be using an inverse and I wouldn't even think really about looking at the market structure shift. Yes, the macro still exists. Yes, I'm still looking for a sweep, but I'm more trying to target low resistance and then also, looking for an inversion fair value gap. So we'll mark that out and then we'll go back to the previous macro. Let's see what we've actually marked out here. Now, let's play this out and then I'm going to talk about something different because a lot of people ask me about trend continuations. I won't take certain trend continuations and this would be an example of a trade that I probably wouldn't take, but let's talk about it.
Or maybe off this order block, these last 2 up close candles, you may return to an order block here and then entered short. If you miss that, right, then you could just wait for this. Even though this kind of fizzled out, there's usually at least 1 opportunity, sometimes 2 that you can take advantage of. So
yes, important, right? If you miss the first opportunity, you can come back the next macro and there's probably going to be an opportunity to take another trade. In this macro here that I'm talking about, I would not enter short because in this segment here, I would need to see an inversion fair value gap. I'd need to see that form. If that formed with enough displacement like that, then maybe I would enter short. But these days, I don't really enter from order blocks being traded into. I'll enter from order blocks being created at the same time that an inversion gap also gets created. So take a note of that. But again, let's move on now. I think this is the next day we're talking about another set of macros. Let's get into it.
And then let's put another one at 10:10 and see what happens in this time frame. So do we raid liquidity? Yes. We take out this swing low and this swing low, relative equal lows. Yes, we do raid liquidity. Do we get a market structure shift? Yes. We push above this high. And technically that's a swing high here. We close above that with a body. And what else is this macro telling me? Well, it's telling me here that we've taken out some important sell side liquidity. We've had a market structure shift. Maybe now would be a time to go long or look for opportunities to go long. So that's how you use macros again. And there's your bullish fair value gap.
Yeah, so again, I think I'm just using the 2022 model, but in this scenario here, if I just go back a little bit, just so you guys can see, there is an inversion gap right here, and that is what I'd use to enter, right? I'd use the inversion gap to change in the state delivery, and these 2 highs here, I would class as low resistance. Now, looking at higher time frame structure now, I think last year I was always just trading just a lot of the 1 minute, but now I really like to look for the higher time frame structure. In that case, I'm just looking for the 15-minute chart. So again, yes, that's a key buy side level. I do agree. And the next macro here, I mean, here's the thing. Let's see what I say. But just because it's a macro and there's an inversion gap, it doesn't mean I'm going to take the trade. That's something really important to keep in mind. There still needs to be a clear draw that I want to target, and it needs to make sense for me. So let's see what I say.
You really want those macros to provide something. Now, in this macro, what do we do? Do we rate liquidity? Yeah, we do. So we take out this swing high, which is good. We also tap into this fair value gap here, which is cool. Do we have a mark?
Now, before I even talk about it, I wouldn't be going short these days from now. I know it does go down, but there are relative equal highs here. And if I miss that initial move to the upside, I would be patient and wait. And it'll just be something where I miss, because I've seen way too many times now that these swing highs get swept. And again, you're going to see here that my progression as a trader is there. Like, I don't use exactly the same thing, but this is me trying to rationalize for myself in my mind how I like to trade macros. And a lot of the stuff is still the same. Like, I've always known, okay, look for the macro, look for something important to happen there. But what I'm looking for now is slightly different. But there are some similarities, so we'll keep playing this.
Fair value gap here, which is cool. Do we have a market structure shift? I mean, technically there's a swing low here, so you may class that as your market structure shift. Fair enough.
And here's the thing, right? And the thing is, sometimes you don't get that shift, and there'll just be an inversion fair value gap. So that's one reason why I did switch from the 2022 model to the inversion gap model. And also, I didn't want to wait for a pullback, which I might even talk about here. We'll wait for that.
And what else is it telling me? It's telling me that potentially we may be wanting to head lower. Now, what else do I see in this macro? I see this bullish gap from this candle's low to this candle's high. I see that disrespected. You know what that becomes? It becomes an inversion fair value gap.
Perfect. Yeah, so I am still talking about inversions here, and I'll mark this out here on the screen.
So I see price pushing past and potentially returning to this inversion as a point of entry.
Now, one point about that, guys, is I don't enter from the pullback anymore like this. Like where we pull back into the inversion, I never do that anymore. I wait for the pullback to happen, and then a respect of that inversion, displacement back down, probably roughly about here, and that would be the next macro. That's where I'll go short with my stop above these bodies, targeting this swing low as a base hit. So I've kind of changed how I do it now, and that's one thing that I've adjusted based on what I've learned, and also what works for me majority of the time.
Which also lines up with this bearish fair value gap. So that would be an entry point that I'd like to see price return to. Now, if I get my Fibonacci, this swing high to this swing low, notice, and I'm just going to get these 2 points up too. Notice that part of that bearish gap and part of that inverse gap line up with the equilibrium.
Yeah, perfect. So I'm talking about optimal trade entry here. That's still a big part of my trading. Big part of my trading, because you got to think about this, guys. You got to think about what's the fair level to enter shorts or longs. You're going to enter shorts when price is in a premium. You're going to enter longs and price in a discount. And I'm glad I talk about this here because, again, it's a big part of my trading now, and it seems to be a big part there. But I would not be entering like that anymore. No way. I wouldn't just enter here with a stop above the high. Nah, because I got wrecked way too many times. I would enter here like I talked about, and then put my stop above these bodies. And that way I've got that confirmation that price actually wants to head in my favor. Let's see what I talk about in the future here. So this macro here, to be honest with you, there's nothing that I would have entered from. Like, yes, the macro spools, but there's nothing I would have entered from. So let's see what I say.
Taking out a bit of sell side, but what else is left? All of this trendline liquidity here is still left untouched, and London session lows have been left untouched.
And again, we see this time and time again, right? Price takes out that trendline liquidity. And this is just to show you guys that not everything will be the same for me. Like, I don't use exactly the same entry models, but a lot of the concepts I've been practicing, I've been forward testing, I've been collecting data on for over a year now. So this just goes to show, this is one of my earliest macro videos. And I started this channel in October of 2023. So it's been, I reckon, over a year since I posted this video. And we can probably see, 22nd of November here. So we're looking like over a year ago, just so you guys know.
Which would be a drawn liquidity. So you may want to go short, but before you go short, you know what price has to do? It has to go up. So price has to go up before it can then go.
Now, I wonder if I'm going to mention it here, but there's a very clear 3 drives pattern. You can see 1, 2, 3 drives. After that 3 drives, price aggressively sells off, and that makes sense. That's what I trade now. I look for 3 drives, I look for low resistance, and I take the shorts, towards that point.
Down, which we'll talk about. So this macro doesn't really do too much for me. So that macro I wouldn't really use, but obviously, you can see here you've got a market structure shift, fair value gap entry here.
And again, these days, I'm not too concerned. Not every movement I need to take. I think a year and a half ago, a year ago, whatever it was, I was more concerned with trying to take every single move, and I'm thinking in my head that I needed to. Now, this long position, wouldn't bother with it. I'll just wait. And to be honest with you, I would rather take the long position in the next macro. I know it takes a long time, but I'd rather take the long there using a pullback into OTE and like an inversion gap. That's what I'd rather use.
Fancy fair value gap. This up close candle is a breaker block. A low, a high, a lower low, a higher high. So
Yeah,
you've
it's
got
true.
a breaker block here with this green candle, which I'll put out in time.
Yes, breaker block. Technically, there's different definitions. For me, probably I'd class all these green candles as the breaker, not just the last one, all the green candles. Again, I think, I praise ICT for teaching me concepts and the raw concepts, but I think a lot of people try to be too precise with it. A breaker block is a breaker block. It's just the zone, guys. And too many people get caught up on, I need to pick the bottom, pick the top, or this perfectly reacts here. Yeah, sometimes it will, right? Sometimes it will, but sometimes it won't. So you can't act, and I'm not going to act like every single thing, every single macro works perfectly. Sometimes the price prints outside of the lines because we cannot, with 100% certainty, predict what the market's going to do. Sometimes we can, but keep in mind it's probability, right? So if you get it perfectly correct, like, once we sweep this low, we're going to react, and you get it perfectly correct one time, I guarantee you it's not going to happen every day. And that's the reality of trading, which I think has been a big change for me too. Recognizing, and when I teach people in my premium Discord one-on-one, recognizing that sometimes everything will look good and the trade will just not work out. You did nothing wrong. I did nothing wrong. It just didn't work out. And I think, before I used to come up with reasons as to why I was wrong. Obviously, in hindsight, you can pick up reasons why you're wrong, but realistically, it's probability based. Unless you have an 100% win rate strategy, then sometimes a loss is a loss that you have to take. Let's keep playing.
You've got a bullish fair value gap, and I'm kind of mixing in these macros with potential trades you could take, right? So that's your breaker block. And I'll try to keep this video under 15 minutes. There's your bullish fair value gap, which I can extend out in time. Cool. Low, high, lower low, higher high. We have a clear market structure shift. We've got a clear change in the state of delivery.
Yeah, cool. So for me now, again, I use more changes in the state of delivery. That's what I like to use more. Let's zoom forward a bit. Let's see what I talk about. Yeah, I'm still talking about Fibonacci's. You can see how it reacts there. I wonder if I mark out the inversion gap afterwards in the next macro. I wonder. Let's have a look. Let's play it out.
We've only displaced up a little bit to fill this imbalance. We've come back down again to retest this imbalance and this order block. So we're retesting it. The bodies, give or take, are respecting this breaker block if I make that full, right? The bodies are respecting.
And again, I'm just getting too caught up here with the perfection. Like I said, sometimes it's going to be perfect, other times it's not. Don't worry about it. Just look for price, look for repeatable things, and take a trade. If it fits your model, take the trade. If it doesn't, don't worry about it.
This breaker block. We're displacing from the breaker block and the fair value gap, which I might as well change to green because it's a bullish one. So for me, I'm thinking, okay, we've got displacement once here, we've got displacement again here. We're in a macro. The macro's left another bullish fair value gap, which is right here, right? And you can see we're returning into that gap, and here's another opportunity to go long.
So yeah, I think my main focus back in this time was fair value gaps, not inversions. Whereas now, I'd be waiting for this to get inverted, and I'd enter from here. My stop would go below the bodies, but I'd still be using optimal trade entry. I'd still be using sweep. It's changed a little bit, right? So some of the things have stayed the same, other things have changed. Let's see how this video ends.
Right, a little bit after silver bullet, but still fine. Stop loss below that low, targeting this swing high, right? Completely fine. 1 to 2 risk to reward, another opportunity.
Yeah, so I talk about a 1 to 2 risk to reward. That's what I used to do, but it just, for me, now I prefer taking a base hit. I prefer taking in London or Asian session. It has to be at least a 1-to-1. If I feel like price is going to run, then I'll hold it and then go for a 1 to 1.5 or 1 to 2. It just depends what the market wants to give me. So I'm a bit more flexible now. Sometimes, when I first started trading, I'd go for a 1 to 2, but it just didn't make sense based on market structure. And I was leaving money on the table when I could have taken a partial. So that is the first video of me just reviewing old videos that I make. If you guys like this style or this format, let me know. And until next time, guys, I'll talk very soon. But hopefully you learned something here about how you can change as a trader and how my trading has changed. I'm not saying what I've said here is wrong. I'm just saying my style has changed for the better based on me, and you're probably going to change too as a trader. So keep that in mind, and we'll talk very soon. Peace.